BHP, Rio Tinto, and Fortescue fell more than 3% today, but the number that matters is not the share price move itself, it is the export figure that preceded it. Fresh shipment data from Guinea's Simandou iron ore project landed in the market this morning, and what it showed was not a future threat, it was a present one. Simandou is now moving material at scale, and the Pilbara's decades-long monopoly on seaborne supply is beginning to crack at the edges. The mechanism that makes this particular day different from prior Simandou warnings is the grade. West African deposits carry higher iron content than the Pilbara's maturing ore bodies, which have been mined for 60 years and are progressively deeper and more impure. That grade differential is not a new data point. Analysts have noted it for years. What changed today is that market participants are no longer treating it as a hypothetical. Foreign institutional selling hit BHP, Rio Tinto, and Fortescue simultaneously on elevated volume, and Singapore iron ore futures dropped 1.9% to US $103.20 a ton, compressing the price signal that underpins every discounted cash flow model for Australian iron ore producers. The question that the futures move does not yet answer is whether this repricing reflects a structural reset in the Pilbara premium or a sentiment overshoot driven by a single export data point. AMP's Shane Oliver has flagged the broader commodity picture as deteriorating. Copper futures fell 2.5% to US $6,075 a pound in the same session, which suggests the selling pressure across BHP and Rio Tinto may be carrying more than just iron ore anxiety. Foreign net flow was the primary driver today. Domestic institutional buying did not absorb the exit, and retail positioning on the ASX Resources Index remained thin. What that participant absence signals about the next session's price stabilization path is not yet clear from today's price action alone.
The Simandou supply story would be difficult enough in isolation. It lands into a domestic rate environment that is already tilted against resource sector valuations. The RBA held its cash rate at 3.6% today, a decision that was widely expected, but Governor Michele Bullock's language in the Senate estimates hearing was not the language of a central bank finished tightening. She said inflation and growth are currently moving in the wrong way, that the Middle East conflict creates a highly uncertain environment for further price pressure, and that the board has now explicitly discussed what conditions would trigger a hike in 2026. That is the detail that repositions the risk calculus for Australian bank stocks and for the broader ASX 200. AMP chief economist Shane Oliver put numbers to the scenario. The cash rate peaks at 4.85%, requiring 2 more hikes beyond the 3 already delivered this year, with every 25 basis point move adding roughly $90 per month to a $600,000 mortgage. Roy Morgan's April data shows 28.2% of mortgage holders, approximately 1.47 million people, are already at risk of stress. That figure is projected above 30% under further tightening. Commonwealth Bank fell 1.32%, Westpac 2.15%, NAB 1.42%, and ANZ 1.27% today. Moves that are proportionate to the rate signal, but which reflect domestic institutional positioning, not the foreign selling that hit miners. The bank sector's repricing is driven by a different compression. If the RBA must hike to contain Middle East-driven energy inflation, the banks carry that transmission through their mortgage book's arrears trajectory. Bullock explicitly refused to call this stagflation, but her own deputy governor had called it a central banker's nightmare in April. That gap between the official statement and the internal framing is what the June 15-16 monetary policy meeting will need to resolve, and it is the number that bank shareholders will be pricing between now and then.
Treasury Wine Estates surged 13% today, the only large-cap ASX stock to post a material gain in a session where 125 of the 200 index constituents closed in the red. The move reveals where selective capital rotated when both miners and banks were under concurrent pressure, into domestic companies executing structural cost and revenue resets that are insulated from commodity cycles and rate path uncertainty. Treasury Wine's Investor Day announced it would cut its global portfolio from 76 brands to 30, axing 40 labels and concentrating investment in 10 power brands anchored by Penfolds, Dowo, and Matawa. The $100 million per year savings target is expected to be realized by FY29, with premium brand investment accelerating from FY28. The share price reaction, retail and domestic institutional buying pushed shares to $4.64, was not a response to today's earnings. It was a response to the credibility of the restructuring frame, a company shrinking its cost base while concentrating on the highest margin, lowest volume segment of an industry facing moderation trends. The signal embedded in Treasury Wine's 13% gain is that capital exiting the resources and financials complex today was not simply sitting in cash. It was available for rotation into domestic companies whose repricing story is decoupled from the two main pressures on the ASX this session: iron ore supply erosion and rate-driven mortgage stress. Whether that rotation sustains depends on one condition: whether the RBA's June 15th-16th meeting produces language that closes the hike in 2026 door or leaves it open. If Bullock's wrong way framing hardens into a tightening signal, the defensive consumer rotation that benefited Treasury Wine today will face its own headwind. Premium discretionary spending is not immune to a $500 per month mortgage increase. The verification point is the June CPI print, which lands before the next board meeting and determines whether Bullock's highly uncertain becomes a policy commitment. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.